This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
I feel like we should be celebrating today because share markets have had a second consecutive years of double-digit returns. Aussie shares returned 13.8% over the last financial year. And US share markets also hit new record highs right before the 4th of July holiday, just as what Donald Trump wanted. And this is in spite of a lot of negative news that we've had over the last 12 months. We had a market meltdown on a Monday morning in August because everyone thought that we would have a recession and a massive spike in unemployment rate in the US. We never had that. Unemployment rate is still at 4.1% in both the US and Australia. We thought that Donald Trump would go much harder in terms of his trade war and would basically cut down on trade with China and other global countries as well. But seems like he have chickened out a few times and markets kept going up. And we've also voiced a lot of concerns about share valuations with US share premium, basically offering zero premium versus bonds over the year, as well as Aussie shares is at a similar place right now. So despite all of these, how come shares kept going up, Shane? Why did we have a second consecutive years of such good returns?
You've got a long worry list there, Me. It's often the case that markets just surprise people, and that's obviously what's happened in the last 6 months in particular. We had that tariff shock. We've had war in Iran, around Iran, which fizzled.
Well, I completely forgot about that.
That's another one. We've had, in the last week or so, the Reserve Bank disappoint and leave interest rates on hold. So some might say, well, it's kind of negative. But on the other hand, markets often climb a wall of worry. And I think in a bigger picture sense, markets are sort of thinking, well, maybe Trump will chicken out again. So he's back in there announcing more tariffs. But the experience earlier this year was that he backed down, as you pointed out. And so markets are thinking, well, we've seen this movie before. Trump comes out saying all these funny things, doesn't sound good. But if we overreact and sell and go into a panic like we did from February this year, going into April, then we'll just end up wrong-footed. So maybe that's why markets are a lot more complacent. I mean, you could make an argument that they're being too complacent because we get to see the economic impact of the tariffs. They're still, even if they just stay where they are today, they're still, 5 times higher than they were at the start of the year going into the US. That's still going to have some economic impact. And then maybe that's yet to show up, and then that's going to cause markets to run into trouble. But so far, markets seem to be looking through it and don't seem too fast.
So, since then, we've actually had even more negative news after the last financial year. So just a few days ago, the US administration sent out 14 new letters to different countries. Most of them are in Asia. Those include the biggest trading partners such as Japan, South Korea, South Africa, Malaysia, Myanmar, Laos. To me, they seem like love letters or maybe breakup letters, as you said. They basically create a new deadline for negotiation. So if we zoom out a little bit, Trump has set a few deadlines for making trade deals with different countries. The first one was on Liberation Day. That was April the 2nd. He said that tariffs would come into effect by May. But then May came, and then he delayed the tariffs until July 9th. And now the July 9th deadline is around the corner, and he delayed it again to August the 1st. So give us another month of delaying these prohibitively high reciprocal tariff rates. What do you think about the love letters, Shane? I thought they were very amusing.
Well, they are, the way he writes it. Apparently they're all virtually identical, aren't they? And they just changed the name of the country. So you say, Dear Japan, Dear South Korea, and on you go. The tariffs that were announced were basically the same as the April 2nd retro day tariffs from earlier this year, although some were a little bit like Japan might have been 25% as opposed to 24%, so slightly different. I don't know why they weren't identical, but so it looks like he's just reverting to that and then hoping these countries will negotiate. Because don't forget, America keeps saying all these countries are lining up to negotiate, and how many countries have actually negotiated? All they've got with China is a truce which fell apart and then is now back to being a truce. All they've got with the UK was maintenance of the 10% tariff, so I can't see how that benefited anyone particularly unless you're a company exporting Land Rovers and Range Rovers to the US. You get a quota system there. And for Vietnam, horrible outcome. They go from 10% to 20%. Maybe it's not the 46% that was threatened on retro day, but it's still not a great outcome. So other countries are probably thinking, well, it hasn't worked out too well for them, so why bother? Let's see what happens. And you can make an argument. Like I would say, well, to all these countries, better off just do nothing and see what happens. Because if you do nothing, then America pays, the tariffs kick in. Horrible news for US consumers, which will make Donald Trump incredibly unpopular because he's achieved nothing in his negotiations. Bad news for US financial markets. So maybe that's the right strategy. All these countries just ignore him and laugh it off, as you're doing with the love letters. But of course, it's hard to see that happening. I think individual countries will probably sign up to something or other. But so far, it hasn't got anywhere. It's supposed to happen over that 90-day period. And what have they got? Nothing much.
Well, I do think that it shows the limit to what the US administration can do. Trump has explicitly said that he sent out letters to countries who haven't made a trade deal, as you said. He's only made trade deals with 2 or 3 countries. So
but he has been having chats with Japan, and they're upset with him.
He wanted Japan to buy US rice, and they don't really want to buy American rice because.
Well, maybe he has a point. Maybe they should open up the market up. If they've got a rice shortage in Japan, which they should, then the sensible thing is to get the rice from somewhere else.
As a rice lover, the Japanese rice is so much superior.
Why?
Because they use plump, short grain rice. It's very premium. It's a lot more expensive.
I thought the best is basmati rice because it's got a low GI.
Okay, you want healthy rice. I want
healthy rice, yes. But I know there is a debate between, what's the other rice called?
Jasmine rice.
Jasmine rice.
And then the Japanese eat short grain rice, which is different. So only the Japanese and the Taiwanese people eat those. Anyway, I'm really into rice.
Now I've switched to basmati whole grain rice.
That doesn't sound very fun.
Well, after all, you get used to it. It's actually quite nice.
Anyway, so going back to the tariffs, I think it really shows how limited the power of the US administration is. Because all these trade deals, usually they take years and years to finalize. All these, say the WTO, for example, it took years, decades to actually negotiate. So even if Donald Trump wants to remake the global order, disentangle all of these trade relationships, it's just not going to happen in
But
a month.
isn't that a problem for him, though? Because he wants to get in there, sound tough, maximum pressure. In the end, he just shoots America in the foot. They pay more for stuff. And some countries don't bother to negotiate. But the problem is he can only keep this up for a little while because then as he goes into next year, he has the midterm elections. And if all that happens, Americans are paying more for their products that they import. Lots. I didn't realise so much comes from Vietnam. Japan and South Korea are actually quite small. But Americans are the ones who end up paying for this. And the longer it goes on, the more they will pay. And Donald Trump won't have any deals to say that he's done such a great job. I mean, I can't see what was in it for Vietnam. On the one hand, you could argue, well, Vietnam is now having a 0 tariff on US imports.
So that benefits Vietnamese citizens because they buy
everyone
cheaper
in Vietnam's
goods.
going to be buying a Dodge Ram. Is that going to be? Can you imagine all these Vietnamese getting rid of their motorbikes and small cars and buying Dodge Rams?
Well, iPhones are going to be cheaper for them, so that's
good. But ultimately, it's you could argue from a purely economic point of view, because there is a logical argument. If some other country wants to engage in a trade war with you, your best response is actually to do nothing and slash your tariffs. So their consumers suffer, they pay more, and your consumers benefit. And economically, you can show that that's actually a better outcome. So Vietnam, you could argue, maybe perversely, I know this is contrary to what I just said, is perhaps getting the better end of the deal because the Americans are going to be paying 20% on Vietnamese products, whereas the Vietnamese are only paying 0% on US products.
I mean, we can keep going around in circles with this thing, but I think overall the evidence from the US shows that. So there are a lot of questions about who's paying the tariffs. So I still think it's a combination of the original exporting country slashing down their price a little bit, so they absorb a little bit of the margin, and then the importers, so say that's the retailers in the US like Walmart or Target, they absorb part of the cost in their margins. And then the consumers also foot the rest of the bill through higher prices. I think so far it's been a combination of all three. So you can't just say that only the US citizens pay it. But yes, ultimately, they are the ones who pay the most.
Yeah. I think that's right.
Yeah.
Which is obviously what the Fed's still worried about. There's no love letter from Trump to Powell, though. It's more like a hate letter. now he's potentially accusing Powell of lying regarding the renovations at the Fed.
So for our listeners, over the past few months, actually, Trump has called Jerome Powell the Fed chair, the one who's probably responsible for setting interest rates in the US, to let Powell, because he wants US interest rates to be closer to somewhere like in Switzerland, close to 0%, rather than the 4%, 4.25% that the US is having right now. And I think Jerome Powell is basically at a pretty tough spot right now because, yes, economic data seems to be deteriorating a little bit, given leading indicators like company surveys point to further downward pressures for economic activity ahead. So
but
that
the share market at a record high. The share market's saying something to worry about.
So anyway, so surveys do point to lower rates. But on the other hand, all of these tariffs issues with potentially more love letters from Donald Trump sending out over the next coming months would point to higher prices. So that argues against cutting rates. So it is a tough spot for Jerome Powell right now.
Yeah, I reckon it is. Because you have seen on some surveys a rise in consumer inflation expectations. Yeah. So Powell thinks that if he just keeps cutting rates, or if he just cuts rates, and he has already cut them last year by 100 basis points or 1%, if he just keeps cutting rates, then it could lead to higher inflation expectations because US consumers and business people would think, well, you've got this tariff rise, Trump, the Fed doesn't seem to be worried about it, and therefore the inflation expectations could rise. So I could see where Powell is coming from. Yeah. Ultimately, though, I do think he probably will cut rates because the US economy, as you say, is showing signs of slowing, albeit it's a gradual move.
It has to be very gradual because I think for the Fed's job is not just to set interest rate, but they have to look credible as well.
Yeah.
You can't be seen as agreeing with Donald Trump, whatever he wants. You can't be agreeing with him, whatever, like in every time, because you have to be independent as well. I think maintaining that credibility and independence is important for them as well, because it's important for setting inflation expectations.
Yeah. Well, we know from history it's critically important. I mean, it's sad that each generation has to learn the lessons of the previous one, sort of thing. And we learned in the 70s that inflation is a bad thing and that you need to keep inflation expectations down. And to some degree, people have forgotten that. Maybe Trump's forgotten that, the importance of that. But Powell probably still thinks, well, we let inflation get out of control in 2022 and we made a mistake. We can't repeat that mistake. So therefore, maybe he's being a bit tougher than he otherwise should be. But you've got a record share market, you've got very low unemployment. So in that sense, normally you'd say, well, there's not a lot of pressure on him to move just yet.
Yeah. So when do you think we'll see a cut from the Fed this year? Maybe in September?
Like I think probably in September will be when they move. We've obviously got another round of inflation numbers coming up in the week ahead. Yeah. They might show signs of tariffs popping up there. If they don't, then the pressure on Powell will increase quite a bit again. But then you've got another step jump up later in the year. If we get to August and the tariff rates move up again, then he might be inclined to wait. Well, we've got to wait a little bit longer now, which obviously runs the risk of more hate letters from Trump.
I think with the letters, there's a line that I really like. I'll read that out right now, actually. Trump signing off the letter with, "These tariffs may be modified upward or downward, depending on our relationship with your country. You will never be disappointed with the United States of America." I think that to me shows that he's probably going to be willing to cut down a little bit on the crazy high tariff rates that he threatened in April. So yes, we'll see higher tariff rates. I think we probably won't see them as high as, say, 50 or 60%, but maybe closer to 15 and 20%.
Yeah, I think that's probably right. I mean, you can make an argument that on Liberation Day, or Retro Day as I call it, Vietnam was at the very high. It was
Yeah,
46%. I think it was Cambodia was 49. So they're at the very high point. So you can make an argument that if they've settled at 20 in their deal, then that might be the high watermark.
Yeah.
And 10% is the baseline.
Yeah.
So in theory, Australia stays at the 10%.
Yeah.
But there are some more noises around that. In the last little while, we've had Trump talking about 50% on copper.
And 200%
on pharmaceuticals. And according to you, most of our pharmaceuticals going to the US are blood.
Yeah. Unless you're a pharmaceutical exporter in Australia right now, you probably shouldn't worry. So we only exported $2.1 billion worth of medical products to the US last year. That's only 0.4% of our total goods export.
So it's quite small.
So that's very tiny. It's even a smaller part of our GDP. So you wouldn't really see it showing up in macroeconomic data, even if we can't export any of these to the US anymore. And yeah, funny enough, 80% of our pharmaceutical exports to the US are blood products.
So the comments from the Treasurer, this is all very worrying, about these new threats from Trump, we probably shouldn't be too worried about. Obviously, it's not so good if you're a pharmaceutical company that might have your exports affected. But in terms of the total from Australia, it's not that high. Yeah. I mean, the total on the numbers you got for last year was less than 5% of our goods exports go to the US. Yeah. I think if we're going to worry about it, unless you're in that industry, the thing to worry about it more is the tariffs put on other countries and the dampening effect it might have on their economic growth.
Yeah, and probably the major one is China. That's still a big question mark in terms of Trump's policy so far.
Yeah.
We do have an August deadline for Chinese tariffs from the US. So we'll see what happens. In Australia, though, I do think we've had a bit more negative news over the past week. We were expecting that we would get a relief from another rate cut from the RBA, given all of these negative global
say,
news.
Too late Bullock or something? Too late Michelle Bullock or something?
I wouldn't say that. Maybe it's not Bullock. Maybe it's another board member from the RBA that argued.
Could be those other six people.
Argued against.
We don't know who voted which way.
Yeah, so the RBA defied market expectations on the morning of the RBA meeting. Markets were pricing in between 85 to 95% chance of a cut. 84% of economists surveyed by Bloomberg also forecasted a cut, including us.
Yeah, we got it wrong.
And yeah, the majority got it wrong because the RBA voted 6-3 against a cut in the July meeting.
I mean, I sort of wonder how we got there. If I go back to the last meeting, initially we were thinking, well, that the meetings, the rate cuts would come in February, May, August and November or something like that. And then after the May meeting, the RBA was a lot more dovish.
Yeah, and they even considered a 50 basis point
cut.
They
considered 50 and it seemed as if they were saying the risks around inflation are now balanced, but there's more downside risk to growth. And so I think we took out from that, well, maybe there's now a 50-50 chance of a cut coming up in the July meeting. And then soon after that, we got the flow of monthly CPIs, which are on the low side. Most recently, 2.4% for trim mean inflation for the month for the year to May. I don't think people in the market actually focus on the 2.1%. For headline, they focus on the trim mean. They know that that's the one to focus on. And then, of course, we got the GDP numbers, which are also on the low side at the beginning of June. And so they seem to be the reasons why I think we and many others sort of switched from thinking, well, next move in August to next move in July. But obviously we were wrong.
Yeah, the RBA argued against those arguments with two things. One is that they still think that the labor market remains tight. They still think that productivity is quite low. That means unit labor cost is still very high. So that's still some upward pressures in terms of wages growth, I think, in their opinions. The second one is that they have explicitly said that they don't put as much of put as much weight in the monthly CPI indicator compared to the full quarterly data. And Michelle Bullock has also come out and said that rates are going to come down. It's just a matter of timing rather than the direction. So rates will come down, but they were hesitant to move in July. Again, I feel like a lot of times when we do the forecast, we tend to forecast what the RBA should do instead of what the RBA is actually going to do. Do you think that's the case this time?
Oh, it's possibly. At various points in my career, I've thought the Reserve Bank is good at telling us what they've just done and what they're thinking right now, but they're not necessarily the best guide as to what's going to happen at the next meeting or down the track, and therefore you should rely on your own analysis. Lately, I've sort of become a little bit confused because they started off the year quite hawkish in February, then it got quite dovish in May. Now they're less dovish again. So that sort of, you could argue that maybe we've been wrong-footed. I mean, I kind of thought that that's what they should do, ease, and that's what they will do. So I don't think I was just assuming they'll cut because I thought they should cut. You and Diana might have a different take on that. In terms of your own views on it. But, I mean, I was a little bit confused because we all know there's an issue with the monthly, but why do we even have the monthly if we're not going to put some weight on it? And then there was I guess it did seem as if the guidance was quite dovish back in May, and then it suddenly changed a little bit. And there was, as you say, there was a debate about whether to do 50 or 25, which I think was another reason why some thought, well, okay, if they're talking about that, then, maybe there's another one out there fairly soon.
I think further to your thought as well, I think we actually moved our rate forecast to July after the GDP data. So we were not actually dependent on the CPI data to come out.
Not the most recent CPI, it was the GDP.
Yeah,
That's
and
true.
GDP was quite poor. I think 1.3% versus that's basically half of where we should be growing as a country at the moment.
Yeah. I think the most recent CPI just gave us a bit more confidence that they'd cut in July.
Yeah.
But you're right, we did move on the day of the GDP numbers.
Yeah.
And that was quite a soft outcome, particularly in terms of consumer spending, investment and so on. So that, I would have thought, therefore, if they're now more focused on growth as opposed to inflation, they can sort of move away from this reliance on waiting for the quarterly CPI to come out. But nevertheless, we did have 3 people vote for an easing. Presumably it was an easing. That's the impression the governor gave us, that the debate was about whether to hold or cut, that it was about timing, not direction, and the direction still remained down. But there's also been a bit of debate recently about whether those 3 people might have been internals, external board members or independent board members, or whether they were the people from the RBA and the Treasury. If they were the people from the RBA and the Treasury, then it's quite conceivable the RBA is having to now be out there defending a view which wasn't its own view, which, if eventually found out, could cause credibility issues. It's probably may be more of an issue when we're going the other way, when 3 RBA and Treasury people vote for a hike and the independents all vote no. And I think that just highlights a problem with our board, that it's dominated by externals, which is not the case in other central banks where they have externals.
Yeah. So just a note, other central banks do have externals on the monetary policy standing board as well, but they're not the majority.
They're not the majority.
Whereas in Australia, the externals are the majority. They don't work at the bank. They work
That's right.
elsewhere.
They're part-timers.
Yeah.
So I kind of think, well, the RBA, they're the place we're charged with implementing monetary policy and keeping inflation under control and full employment and so on. But, there is a risk here that they might be dominated by externals, which I think could be a problem going forward. And those issues were raised by people like Ian Macfarlane, a former governor, a few years ago when the reforms to the RBA were first put up. But anyway, we've been rabbiting on for a while here. You got another issue.
There's one more issue. How come markets went up the day the RBA failed to cut rates?
Well, I think that the Aussie dollar went up, and that went up because, you got a slightly higher interest rate profile in Australia compared to other countries. Share market, I think, initially, if you look at it between, say, 215 and 245, with the RBA decision in the middle there, it actually was down about 0.1%, then ended up down 0.2%. But I think at the end of the day, it was up slightly. It just moved on to other things. Maybe the markets concluded that, well, the RBA is still going to cut. Who cares whether it's this week or in 5 weeks' time? So maybe there was an element of that. It does seem as if markets are becoming fairly resilient. It's almost like Teflon. You can throw anything and they'll be all right, which is contrary to that chart you keep updating for me, the equity risk premium one, which shows a low relatively high PEs and low earnings yield compared to the level of bond yields. So
Yeah, basically you're not getting compensated for taking additional risks for buying shares versus
that's
safe
like a bit
investments.
of a concern in the short term. But and it sort of tells me there's still a risk of a correction out there at some point.
Yeah.
This week was a funny one. I've always been obsessed with this song called MacArthur Park, wondering where the hell is this park? And it turns out the park is in LA. And there's a line in there about someone baking a cake and leaving it out in the rain and how depressing it is. It took so long to bake the cake and they didn't know whether they can do it again. Anyway, MacArthur Park was in the news this week because ICE agents dressed in army fatigues and driving armoured vehicle characters were in MacArthur Park. I guess rounding up illegal aliens, which seemed kind of threatening. But it just reminded me of MacArthur Park, the song. Richard Harris, you've never heard of this song. Came out in 1968, I think it was. I was probably a bit young.
Of course
then.
not.
We
need to do a poll of how many listeners have listened to this song. Anyway,
okay. Well, take that on notice. If you've listened, if you know MacArthur Park, then send us a message. Anyway, it probably is time to wrap up. I know I got kind of distracted at the start there, but the last financial year was a pretty good one. If you look at typical superannuation funds, my estimates, probably around 10%.
Yeah.
I think some of the AMP funds did a little bit
better than that.
which is good news. But it's still a pretty good year, third year in a row. And as you say, 2 years in a row of double-digit returns from shares. So that's pretty good. History tells us that sooner or later you're going to get what they call mean reversion. We could go through a softer patch. Always going to be really hard to know when that will be. I suspect we should allow for another bout of volatility somewhere out there. Maybe it's the tariffs, maybe it's something else. August, September can be rougher months. But I think in a broader context, we're still going to see central bank cuts. You can debate the timing for the Fed and the RBA. We're still going to see rate cuts though. We still see the RBA cutting to 2.85%, so that's 4 cuts. And ultimately that should keep share markets going. And the key is we avoid recession. Obviously, if we have a recession, different story. We'll be worried about that cake being out there in the rain in MacArthur Park. Anyway, time to wrap up. It's been fun, me.
Thank you, Shane. Keep the party going.
I'll try. We don't have that cake anymore, though.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.